We have heard a lot about risks in the last day. A myriad of risks. We have heard that our government is a risk. We have heard that our fellow citizens are risks. We have heard that Islamic terrorists are risks. We've heard that other cultures are risks. We've heard that our own culture is a risk. We've heard a lot about risks. But in terms of the application of your efforts in your own portfolio, the greatest risk that you are going to face is not, in fact, taxation. It's not regulation. It's not issuer fraud. It's not the clash between Islam and Christianity. It's not even peak oil. The greatest risk that you face as an investor, not as a human being, but as an investor, is conveniently located to the left of your right ear and to the right of your left ear. Quoting that great investor Pogo, we have met the enemy, and he is us. When you take in all of the risks that face you, it's the risk that you run yourself, not managing your emotions, not managing your intellect. It's the risk that you make a mistake that's a controllable mistake. George Soros, I think, put the investing process and the risks that we can control ourselves in, he crystallized them when he said that he had become a billionaire by finding commonly held precepts that were incorrect and betting against them. And there are a lot of commonly held precepts in the world that I think you can bet against, and I think you have to bet against in order to do well. We are entering into a period, in fact, we've entered into a period of the market now, which is going to go on for quite some time, I think, that is going to be punctuated by a whole bunch of stuff. But the most important thing in the near term it's going to be punctuated by is one word, which is volatility. Volatility, as is measured by the VIX, the volatility index, I think will be over 30 for a substantial period of time. That's basically unprecedented, except for parts of 2007, 2008. One widely held precept is that volatility is the same as risk, and it isn't true. There's another widely held precept that volatility is bad, and that isn't necessarily true either. Volatility refers to pricing, and I know from being a broker for many of you that almost nobody in the room objects to upside volatility. When stocks jump 30% for no reason, and they validate beliefs that people in the room have had with regards to the value of their portfolio, that's good. 30% increases for no reason whatsoever, that's wonderful. It's the downside volatility that seems to bother people. I don't know why that is. What is 30% decline? If you were going to a grocery store, if you were going to a department store, if you were going to a clothing store, that would be a sale. How would you like it if you were going to look for a car? Let's say that you decided that you wanted to have a Lexus or something like that, and you went to the car lot, and the Lexus that you wanted was, I don't know what a Lexus is, $60,000, something like that. And you went back 2 weeks later, and the Lexus was $40,000. Would that be a bad thing? Anybody here object to that? 30% off sale? For some reason, when small natural resource stocks fall 30%, it's bad. People want to sell them as opposed to buy them. And that's what I'm talking about in the context of the fact that the greatest risk that we all face is to the left of the right ear and the right of the left ear. The fact is that we have to regard volatility as an opportunity. If we don't take advantage of volatility, the markets will take advantage of us. This is an example of a widely held precept which is wrong that we have to bet against. The only thing that we have to do to determine whether or not we take advantage of volatility or we are taken advantage of by volatility is operate, recognize the great risk that we face, which is ourselves, and act on it. We have very well presented before us a sense of where the opportunity is in the natural resources market. And so let's talk about the origins of volatility in natural resources. In the first case, part of the bull case for resources was, as I say, presented right before me. The decline in grade, the decline in margin, the decline in energy efficiency in extractive industries. Yesterday you heard Steve Yusby talk about the challenges that we face worldwide in agriculture and in water. So we have in resources, I think, a bull market that will go on for a substantial period of time. But it's going to be a bull market that is going to be punctuated by periods of extraordinary volatility. How many people in the room were gold bugs in the 1970s? Let me illustrate this volatility. Some of you will remember this, perhaps painfully. In the decade of the 1970s, the gold prices, you'll recall, began at $35. It ended the decade at $850. Pretty good run. Do any of you remember the fact that in 1975, the gold price fell from $200 an ounce to $100 an ounce? In the midst of the biggest gold bull market in all time, the gold price fell by half. It wasn't a secular decline in gold, it was a cyclical or volatile decline in gold. And there were people who, at the beginning of the decade, anticipated the fact that gold would run from $35 an ounce to some much higher number. And as a consequence of not being either financially or psychologically prepared for the volatility, they still lost all their money. Very, very, very important lesson. You must have liquidity and you must have courage to accept and profit from volatility, even in a secular bull market. The volatility specific to our industry, the resource industry, is a function, as I say, in the decline in the quality of natural resource assets. It's also a function of the fact that we entered a bear market in resources in the early 1980s, which continued to the earliest part of the last decade. There was about 20 years where society as a whole didn't invest in natural resource-based businesses because the margins were declining as a consequence of over-investments in the 60s and 70s. Remember that these are very, very, very cyclical, capital-intensive businesses. And so the situation that was described by the prior speaker, which is a decline in the quality of resources available, was exacerbated by 20 years of underinvestment in natural resources. That's the supply side of the equation. The other side of the equation is the demand side of the equation. As was again pointed out by the prior speaker, on a worldwide basis, population is growing, and at the same time that the number of capitas, that's people, increases, per capita consumption of resources is increasing. Particularly at the bottom end of the demographic pyramid, those 3.5 billion people at the bottom of the demographic pyramid, those people all want to live like you. And as they get more money, and by the way, they are getting more money, the bottom of the pyramid is becoming progressively more free, and as a consequence of becoming progressively more free, they're getting progressively richer. Commodity consumption is increasing per capita, and the numbers of capitas are increasing. This is very, very, very important. These are very, very, very important things to consider. So part of the volatility comes from the fact that I think that the resource sector will do better than other sectors in the economy. There will be bullish forces that will give you upside volatility. On the other hand, the broad economy, the political economy, the broad stock market, I think are in very, very, very difficult times. You know, people talk about asystematic events, black swans. If you were at this conference yesterday, you saw so many potential black swans that they resembled a flock. What could go wrong? Well, what couldn't go wrong? There were a whole set of circumstances that are suggested to have been responsible for the 2007, 2008, 2009 liquidity crisis that we experienced, and I personally don't see how any of them were addressed. As an example, Greece has a difficult time making payments on debt at 150% of GDP. Does anybody believe that increasing Greece's aggregate debt from 150% of GDP to 165% of GDP is going to solve the problem? And that's just Greece. So that's the nature of volatility. On the one side, you have extremely dangerous sets of asystematic events credit contractions, illiquidity. And on the other side, you have an incredible base of support for natural resource-based businesses. And think of it as two enormous weather systems. When these enormous weather systems collide, what happens? There's lots of turbulence and lots of volatility. And I would suggest to you that the most important thing that you can do for your portfolios for the next 2 or 3 years is, first of all, remember the thesis that on the supply and demand side, resources are going to be more and more and more valuable. But in the context of that, the financial market, the pricing associated with the equities of companies that control or are looking for natural resources are going to vary, and vary in extraordinary degree as a consequence of volatility. If you are the type of person who, when a stock goes from $1 to $2 for no reason, thinks that's good and buys more, this is the equivalent of a $60,000 Lexus that you're now buying for $120,000, you will not do well in this market. If you are a person who understands that he or she must use volatility and would rather pay $40,000 for the Lexus than $60,000 for the Lexus, as a consequence of volatility, you will do well.
You have to be cognizant of the fact that when you have money at a bank, you have a risky investment. Most people don't think of it that way, but certainly I do.
Money in the bank, that's not a positive anymore the way it once was.
No, it's not a positive.
And your answer is go physical. You want to talk a little bit about that?
Yeah. Well, I think there's very few things that you can buy in the kind of financial and economic setup we have. And we've talked about the economic setup. I mean, are we going to a recession? Are we going into a depression? Mm-hmm. How do you survive in a situation like that? And the most obvious thing is to own precious metals related investments, whether it's physical bullion or gold and silver stocks. I mean, people can make a case for owning productive farmland, things like that. Things are absolutely necessary in the kind of economic environment we see. So that's why it's easier for people to invest in gold and silver, and that's why I push people to do that.
Now, we saw in 2008, big upset, a lot of fear. You'd think that gold would spike because of the panic in the streets, but gold dropped. Yeah. Because relating to what you were saying before, you can't sell anything. Where's the asset you can sell? People sold gold. Yeah. Do you think that the potential for that to happen is there again? Can we see gold and silver drop even when they should go up? Will we, or have we already washed that out of the system? Where are we at now?
Sure. Well, as you know, we see it all the time. We see it just recently in the silver and gold prices. And I believe that because the powers that be, the central banks and governments, try to keep people believing in the framework, the economic framework they have, I believe they are active in these markets from time to time. So you can never draw a correlation. Gold went up because of this. Mm-hmm. And so whenever it gets a little bit closer to the ultimate crisis, I actually believe that forces are put at work that can move the prices down. And it's been talked to that this is what's happened recently. I believe it totally, because the situation just gets worse every day, but the price of gold goes down. It absolutely makes no sense. Are we going to have an 08 repeat in terms of the share prices? The one unusual thing that happened in 08 was that the silver price really crashed and went from $21 to something like $9. As you know, there's ongoing lawsuits against various firms, JP Morgan and HSBC, being involved in a manipulation of the price of silver down. I would expect that if there was a proper investigation, they might determine that that was the case. Had that not happened, I think the market would have acted very differently. Two, even though the market went down dramatically in share prices, within 15 months, they came barreling back, and of course gold was up that year. Gold was up every year subsequently. The reason to own gold never changed. So I think, having seen it once, I don't think we'll see that same play out that we had then. There's been recent evidence of difference in the market. And I forget the date, but I think it was something like August 10th when the Dow was down 500 points. And the UE gold index went up 4%. So we had something like a 900 basis points difference between the two. And I thought, oh my God, it's like a eureka moment where the gold stocks disassociated themselves from the stock market. We had another example of that this last Friday, where the market was down something like 230 points and the UE index went up. We see more and more examples of it all the time, where finally people are realizing that gold stocks are different from regular stocks. So I don't think we'll see the same carnage, although we always see raids on the gold and silver prices by the paper sellers that far outnumber the real buyers, the physical buyers. But if you wait it out and the physical buyers come through, which it looks like they're going to come through here, then everything will revert to norm again.
Okay, you said this morning that the last decade, 2000
Right.
to 2010, was the decade of gold, and the
Yeah.
upcoming one is the decade of silver. Can you
Right.
tell us a little bit more about that?
Sure.
If all these things happen, gold should still go up.
Oh yeah, I have no doubt that gold's going up. Don't get me
Okay.
wrong. I think it's going up. I just think based on the evidence that we all see of the massive amount of silver buying vis-a-vis gold, where people are almost putting as many dollars into silver as putting into gold. But the price is 50 times different, but the same amount of money is going in. And the availability for investment is in a ratio of about, there's 20 times more gold in dollars to buy that there is in silver dollars to buy for investment, yet the money's going in at 1-to-1. Well, I know as kind of a mathematician or a logician, that cannot carry on. Something's going to give here. So that's why I think the silver price in the next decade will do better. Not something I spoke to in the talk, but something that people should have in the back of their minds. I believe that gold, the market has determined that gold is the reserve currency today. It's outperformed everything by a wide margin,
Right.
not even close to being comparable to anything. And people do talk about backing currencies with gold. Well, if they back currencies with gold, you need a monetary item that's in smaller quantities,
Right.
which has to be silver. And can you imagine the physical demand for silver if we had to reintroduce silver as a
Coinage.
currency? It would
Yeah.
be unbelievable. So I think that's another more macro long-term thing that would suggest that
Sure.
in this decade, should we ultimately collapse the financial system and say we got to back the currency with something real, that then silver would have
That's very interesting. So a lot of people like to talk about the gold-silver ratio and how it's out of whack, but you're not talking about ratios. You're just looking at the facts of reality facing these
Right.
supply and demand.
just the buying. I mean,
Yeah.
and I always say, nobody's making these people buying it. They're just buying it. And if people want to keep buying it on a 1-to-1 ratio, the price could not, stay at 50-to-1. There's no way.
And owning the stocks versus owning the metals. There's a perception out there that, well, we have these ETFs now, and so maybe the stocks aren't going to do it this time around. This market will be different. If people just buy the ETFs, it's easy. Do you subscribe to that, or do you think the stocks will still give leverage to the commodities?
I would say right now I'm in the camp that believes that the precious metal stocks are getting so cheap that they should outperform the metals here. Like, they are incredibly inexpensive on any metric you want to use, and compared to any industry you want to compare to. Where the outlook for gold and silver is likely that the price goes up. The outlook for almost any other commodities is that the price goes down, and yet we're trading at very low multiples of earnings. We haven't even seen the earnings power of these companies at these prices yet because there haven't been that many reporting periods. So personally, I've sold gold to buy gold stocks and silver stocks.
Okay.
I've not yet sold silver to buy silver stocks, but I think the precious metal stocks are in a way better situation today than they were before, because the market has not discounted gold having gone up to 1,600 or 1,900, which it was recently. I think there's better value in the stocks.
You've been an outspoken contrarian and right and for a long time. But I'm wondering, now that all of what you've been preaching for the last decade and probably longer is coming to fruition, and gold is $1,850 or whatever it is today, who's contrarian now? Is it you? And I'm wondering, is it not somewhat contrarian and therefore bullish in your core philosophy to be long U.S. equities or long U.S. real estate?
Well, first of all, gold isn't cheap anymore. That's too bad for the latecomers to the game. But it's going higher. Don't worry about there being a bubble in gold right now. There's not a bubble in gold. It's just coming to the public's attention, but there's no bubble in it by any means. I think that in terms of today's dollars, it's not at all unrealistic to see gold at $3,000, $4,000, $5,000 an ounce. When will the top in gold come? I expect when Newspeak or Slime magazines, should they exist that far in the future, several years more even, when they run a picture of a golden bull tearing apart the New York Stock Exchange, that would be the key to sell gold and buy stocks. Now, why don't I buy stocks now? Because they're not cheap now. People forget that historically, market bottoms have occurred when the market as a whole yields 6 to 8% in dividends. I think by the time the market bottoms this time, it could be yielding more than that, and that's after they cut dividends. So I have no interest in stocks. I'm getting kind of interested in American real estate. If I owned Vancouver real estate, incidentally, I'd hit the bid tomorrow morning. This is one of the last remaining bubbles in the world in terms of real estate. But I'm looking to buy single-family houses right now, actually in Las Vegas. Maybe a little bit early, but I'm getting interested. But generally, I'm not interested in real estate. Bonds, forget about it. Incidentally, that's one of the best one-way speculations. You can make a fortune being short bonds at this point. So just a few thoughts.
So you said a minute ago, and everybody kind of says this, that it's when the gold bull's on the front page of the New York Times. Obviously, we're at the top of the market, and I've got some friends in around Vancouver. Obviously, I know you're a junior resource sector investor and a junior gold stocks investor, particularly. And in the spring, Sean Ryan, the famous Yukon prospector, was on the front page of the New York Times. And I remember saying to a buddy of mine, I mean, maybe this is the top. And since then, junior securities haven't done very well. And are you sure right now isn't that top?
Yeah, I'm pretty sure it's not the top, actually. Gold is over 1,800. It's been driven here by fear and by prudence. And that's why you buy gold. And you don't buy mining stocks because of prudence or because of fear. So mining stocks, as we speak, are very, very cheap relative to gold. The reason I like them right now, though, is because with these trillions of currency units that are being created all over the world, there will be other bubbles inflated. A bubble eventually will occur in gold. Not yet, but it will occur in gold. And it's likely to occur in mining stocks, especially these junior mining stocks are likely to be a bubble in the future. They'll catch up and exceed gold as the public piles into them looking for some way to save their capital. So, but don't refer to them as an investment. Refer to them as a speculation. An investment is buying into a business that produces and pays dividends and is predictable. These things are a crapshoot, actually, as a group.
So back to mining stocks and risk reward. I want to just talk about it for a second. Like I spent a time in the bush last month learning how to be a bit of a prospector from a great guide, and what I got appreciation for was I guess sort of the romance of exploration and the statistical crapshoot of the fact that you need so many passionate people toiling and working hard, spending their careers exploring to make a discovery. You need thousands for every few discoveries that are made, and which was why it makes me feel like Vancouver's in a special place because of the significance of the world needing metals. But in your newsletter, you guys talk a lot about junior mining stocks, and it seems like it's getting positioned for a speculative mania to come. But the risk reward really is it's for people with a huge appetite who can really afford to lose it all. So how do you really encourage a retail or a novice investor to participate in something that is so risky?
Yeah, it's very problematical because there are several thousand so-called mining stocks traded here in Vancouver, and most of them have nothing but a hope and a dream. Most of them don't have a prayer of finding anything. Most of them are just crap. So it's fraught with dangers for the average investor. All I can advise is to educate yourself. I mean, you've got to start reading books about geology and studying the markets and then interviewing the guys that run these companies until you start getting a sense for who's real and who's a flake. That's what you've got to do. Most people don't do it. They just buy a stock because it's touted to them by anybody from a friend who knows less than they do to a taxi driver. So of course they lose money.
So how do you see this sort of speculative rush into junior mining stocks playing out? Like obviously you're arguing that uneducated people are going to get into the space and drive the price of these stocks up, and I'm assuming that's when you and your subscribers will be selling.
I hope so anyway. Yeah,
Sure.
that's absolutely right.
So how is this going to start? Because I see a lot in the media of people saying, screw Vancouver, don't let them trick you. Back to early 90s, there was a lot of negative sentiment about what we do here. How do you think I feel like a passionate resource advocate, but how does this trigger? How does this begin?
Well, it's good to remember that the junior mining sector is the most volatile sector on the planet by far. They're more volatile than the internet stocks ever were during the 90s. And volatility is your friend, actually. It gives you the opportunity to sell and buy at radical extremes. And through the 70s and the 80s, the market, the junior resource market, moved upwards 1,000% as a whole, and then lost 95% of its value, and did the same several times in several cycles. So this is a wonderful opportunity that it presents, and I wouldn't say that it's necessarily cheap right now, but I would say the odds of a bubble being created are great. So I think this is a good time to start looking at quality issues.
Sure. So what's going to start? What's going to propel the bubble? What's going to propel the greater fool theory and pushing? I guess it's Americans into our junior stocks. How's that going to happen? Because it doesn't seem like the media wants to let it happen.
Well,
Do we need the media?
do we need the media?
In this particular instance, obviously. You are a media in some sense. So.
Yeah, this is. I don't have a crystal ball, okay, and I'm not a fortune teller, so I can't assure you that it's going to happen, and I certainly can't give you the time that it's going to happen. But at some point, a bubble will be ignited in the precious metals, and it is entirely likely, as people look to panic out of dollars, they're going to go into securities because, at least theoretically, stocks represent a claim on real wealth. So you put those two things together, a boom in gold and possibly a boom in the stock market, not based on fundamentals, but just based on people wanting to get out of dollars, and you could have a super boom in these things. I wouldn't doubt that there are going to be some issues in between now and if we talked again in 3 years that are going to have gone not just 10 to 1, but 50 to 1, even 100 to 1. It's happened in the past. It'll happen again in the future. At the same time that a lot of these stocks are just going to blow up and dry away because the only gold that they have is printed on the face of their certificate. They don't have any in the ground. So
do you think it'll be a short and sweet bubble, or do you think will the end be raising of interest rates and this scenario that this short but painful moment where we all take responsibility for the debt we have and start to build anew, like the new boom you described?
Everything eventually trades for its intrinsic value, however you want to define intrinsic value, and that's going to include the dollar, which is going to reach its intrinsic value. And it's going to include most of these mining exploration stocks, which have no intrinsic value, but some of them are going to hit the mother lode, so to speak, and are going to go 50 to 100 to 1, and it's going to be justifiable. And I think the market as a whole, since most people don't know what they're going to do, and they're going to buy all kinds of stuff, I think the market's going up from here. Now, I could be dead wrong about that. Like I said, I don't have a crystal ball, but I think that's what's likely to happen. So if you want to speculate in something, and people are going to be forced to speculate in the years to come just to hide from the consequences of the government's inflation of the currency, I think that junior mining stocks, for people that know what they're doing, is one of the best places to be. I think that there's also likely to be a bubble that develops in biotech stocks for a number of reasons, and I speak as a long-time amateur science buff there. I'm friendly towards those as well. And I'll give you a third speculation that I think is worthwhile, and that's being short bonds. That's a triple play if you're short bonds at this point, which are at all-time highs. Interest rates have to go up, way up, which is inverse to the fluctuation of bonds. So that's number one. Number two, the dollar is going to collapse, which is also going to destroy bonds. And number three, you've got the default risk, and that premium is going to go up. So if you're looking for one sure speculation over the next 10 years, let's get short government bonds, long-term government bonds. So those three, there's lots of speculation. There's always a new train leaving the station.
So the question is, why have gold stocks been so disappointing? And there are four reasons that I can think of, or that I did think of, and I probably missed some of them. First is the fact that we have ETFs. So for individuals who want exposure to gold, gold became very user-friendly when the Gold Council launched the ETF GLD in 2004, and that now has a market cap of 60+ billion, maybe a little less since the correction. And so it made gold user-friendly, and what it basically did is it raised the bar for gold mining stocks. Who needs an equity if you can just own the ETF, and if you want to get experimental and take some risk, you could margin it and do it that way. So that kind of cannibalized demand for gold stocks. I don't think the ETF actually drove the gold price. I think it helped it, but I don't think it really drove it, but it's certainly been a contributing factor. The second thing, and really I think the biggest one, is that investors, I'm not saying people here, but generally people who might buy gold equity didn't trust the gold price and thought that it would, there was a flash in the pan, listened to Jim Cramer on CNBC, what have you, and had deep suspicions that there was a sustainability to the high level of the gold price. And I'm going to go and address that in detail in the next few minutes. Another thing that was going around was margin pressures and the thought that, gee, oil prices are going up, base metal prices are going up, the cost of building new mines is going up. So these guys are never going to make money, and I'll address this too. But that certainly was one of the perceptions, I think, that has weighed on the share group performance. And then lastly is this idea, and I think this is very important, it's not spoken about much, is that gold stocks in 2008, so I call it the hangover from 2008, were disappointing. Those of us who own them, when I woke up the morning after JP Morgan took out Bear Stearns, I said, my God, I'm going to have a great year. My clients are going to love me. Gold was $1,000. And then as the year progressed, the gold price went from 1,000 back to 700. But the gold stocks just were in steady liquidation all year long because, of course, we did have a bear market. So one of the things I think that has disappointed investors was the fact that in a world in which most people who own gold would have cheered that, gee, the financial system is coming apart, gold stocks in particular didn't do the job. The metal itself actually finished the year up slightly, but gold stocks were down roughly 30-35%, and the small cap stocks were down 80 and 90%. As bullish as I am on gold, I'm even more bullish on gold equities. This deals with the issue of the gold price. The fact that the spot price went into a steep rise starting at the beginning of this year for all of the headline issues that we know about was certainly gratifying to people who own the metal. But the stocks kind of just lumbered along and didn't really participate. One of the reasons for that, and I think it's a plausible reason, is that gold companies get paid on the average price of the quarter. They don't get paid on the spot price. And so if there's any suspicion or skepticism that the gold price might have a pullback, as it in fact has, a reasonable investor would have waited to see where the gold price is pulled back to before you could start to price in a higher level of gold prices. So I think what you're going to see in this current quarter, the third quarter, which just finished, you're going to see some just unbelievable numbers. Earnings and cash flow. You're going to start to see dividend increases that are going to make the gold stocks look very cheap. And if in fact the gold price at around 1,600 has basically bottomed out, and we look at this any number of ways, we think the chances are pretty good we have a tradable low here, then I think you're going to start to see some positive action in the gold mining stocks because their earnings are going to be so strong. And believe me, $1,600 gold, not $1,900, but $1,600 gold is not being priced in to gold mining earnings at this stage. Another issue that I referred to was the margins. And you can see from this that in the last couple of years, and Rick referred to this, is that the cash flow of the industry is starting to be very, very impressive. And this is very interesting because it's happening at a time when most businesses are struggling. Certainly certain companies are profitable because they're not spending and harboring cash. But if you're a generalist and you just put a piece of tape over the word gold, and a generalist investor just looking at the basic earnings and cash flow diagnostics of the industry, they would have to say, and then look at the valuation, they're going to be compelled to think that gold stocks represent a value opportunity, forgetting about any sort of view of the future gold price, but just sustaining the gold price at around these levels. So here's a very simplistic cartoon, but it basically tells you what gold stocks have versus the metal. Bullion is a bet on depreciation of paper money. I fully subscribe to that. I think that's what we have facing us over the next many years. But gold stocks represent that, as well as the potential for internal growth, particularly in the smaller cap stocks. We talked about dividends, and then of course there's M&A potential. The large cap mining companies really are not equipped to regenerate their reserve profile internally. They basically are in the business of building and operating mines. So exploration, which is really the intellectual capital of the gold mining industry, tends to be in the smaller cap companies. So there will always be M&A activity. Rick referred to that, and I completely subscribe to that. So those are three ways to get return in a gold mining stock, only one of which is shared by the metal. And so in theory, and our numbers have shown in practice, that you actually can get excess return over what the gold price does. But again, it takes a lot of due diligence. You have to pick and choose. We make our share of mistakes and all of that. But if you do a decent job of that, you should be able to do better than the gold price itself. And in my view is you should have some physical metal because that's safe and there's no business risk. But for the more risk-oriented investor, having some exposure to gold mining stocks does make sense. The key thing for gold stocks is a view of the gold price, which is the one I have, and I think I'm right, but I've been proven wrong, is that we're entering a period of permanent repricing of gold. These companies are not Ford Motor, where you have a reversion to the mean, or a copper producer where you have a cyclical downturn and copper prices tank. The world we live in, we're basically going through a revolution in monetary arrangements. And those arrangements are going to result in a higher price of gold, higher than where we are today, and it's not going to be mean reverting. Gold is not going to go back to $250. It's not going to go back to $1,000. It's probably not going to, we're going to look at it in a few years and say, gee, gold at $1,000 was really a bargain. So what are the implications of that for gold mining stocks? It's that they have a level of profitability that was unimaginable when we started our gold fund 10 years ago, 12 years ago. And it's going to involve a permanent revaluation of the sector.
I think that with the trillions of dollars these governments are creating all around the world, the chances, it's almost a cinch that they're going to create lots of bubbles. I don't know where the bubbles are going to arise, but they're being created now. And it seems to me that it's really likely that, almost a slam dunk, one of the bubbles is going to be in the precious metals for all kinds of reasons that you've read about. And a super bubble, because it's such a tiny little, not even a micro cap, a nano cap, used to be a pico cap section of the market called these exploration stocks, is likely to be ignited in these things. They'll be completely irrational and goofy, like they've all been in the past. But I think there's an excellent chance it's going to happen. If I'm correct, now that we've gone through the stealth stage of the bull market, long past, we're at the very tail end of the wall of worry stage now, where the bulls and the bears are fighting, but the bulls are winning. So the next stage is when the bubble is blown up. The mania is ignited. So value's got nothing to do with it. It's irrelevant, totally irrelevant value. It's promotion, it's story, it's that type of thing. And there could be just a huge amount of money that flows into total garbage. It makes no difference if it's total garbage. It's irrelevant. So I think that's a reasonable bet. Now, my ideal speculative portfolio, and I try to keep this in the back of my mind, is to take your money and divide it into 10 equal sections, each of which is in a separate and unrelated investment. That doesn't mean buy 10 different penny mining stocks. It means like maybe buy a piece of real estate in a piece of real estate in Bolivia. Maybe buy these penny mining stocks. Maybe it means short bonds. Maybe that's 3 of them. Okay. Now that's the ideal thing. Any one of which, 10 different separate unrelated areas. Any one of which, in your subjective opinion. That's the important thing, because everything's subjective. I mean, your opinion is not going to be the opinion of a reporter from Time magazine or something like that, his opinion. In your subjective opinion has the probability of going 10 for 1 or something like that over the course of a business cycle, or whatever that may be for that investment. Now, that way, if you're right on just 1 out of the 10 things, you've conserved capital, even if you're wiped out on the other 9. And maybe you'll be right on 2 and kind of right on a couple more and get wiped out on a couple and maybe lose 50% on a couple more. But you're going to do a lot better than 1% or 2% in the bank, which is what most people are doing today. And I think that's a good approach to take, just with that kind of approach. So what's going to happen? Well, I think we're going to have a collapse of the government. A collapse of the government. Now, I look at this 2 ways. I say, hey, that sounds wonderful. The government's our enemy. If they bankrupt themselves, that's absolutely wonderful. And maybe we'll get to live in a libertarian paradise. But then I think, no, that's really not what's going to happen. It's actually, when the government collapses, and it is going to collapse, as you can see, just the interest alone. In a few years, is interest rates inevitably, I don't have time to talk about that, my time's already up, go back to where they have to be. Interest alone is going to go to half of that pie, while everything else is growing. But we're already running $1.5 trillion per year deficit. So it's unsustainable. So the government is going to collapse. Well, what's going to happen then? Well, I gave you the good government collapses, okay, fine, we're all better off, but no, that's not what's going to happen. The French Revolution in 1989 was brought on by a financial collapse of the French government, actually. Did things get better after Louis XVI was kicked out, which was a good thing? No, it got much, much worse. They had Robespierre, and then it got even worse. Then they had Napoleon. So no, things got worse. How about in Germany in the 1920s after they destroyed the mark? Well, you know what happened then. I mean, you need a guy like Hitler. How about Russia? It was a financial collapse of the Tsar's regime. No, things got worse, and they stayed worse for a long time. The fact is when a government collapses, especially when the government is providing all the things that it's providing in the US today, people want somebody to fix it. They want those things back. So inevitably, you get some moron who says, I can do it, but I need more power. So the government reasserts itself. It reasserts itself. And where does it get the money? Well, it's going to get the money from the people that have it. So I think it's going to be very, very bad. I don't see any way around. Actually, we're already moving into a police state, but it's a police state with a fairly high standard of living today, no question about it. I think the standard of living is going to drop. Financial markets are going to become chaotic, and we're actually going to move into something resembling a dictatorship. I'll bet you money on this. In fact, I am betting money on it. So what can you do about it? Well, there's nothing you can do about it. I mean, you're on an Indian reservation. It's called the United States. The best you can do is learn to speculate, to capitalize on the distortions and misallocations of capital that are inevitably going to be liquidated. This is a trend which it seems to me is absolutely, there's no way of turning it around. Showed you how it could be or should be turned around as quickly as you can, looking at something as gigantic, the biggest thing in the world, the US government budget. But it won't be turned around because it's like a snowball rolling down a hill. How do you stop it? It gets bigger and bigger and bigger until inevitably it smashes into the village at the bottom of the valley, and then you start all over again. But the next step is going to be something resembling a dictatorship. Nothing you can do about it. Nothing you can do about it. You think voting for Rick Perry is going to help? Maybe re-electing Obama? No, forget about it. There's nothing you can do about it. Best thing you can do is capitalize on it the best you can and get out of Dodge.
Gold stocks really sort of underperformed bullion over the last little while, or last few years.
Couple of years.
Why was that?
I think it's the worries about a bear market and the fact that gold stocks are stocks and tend to perform with stocks and not bullion. They are riskier because they have business risk. The ETF, the gold ETF, has made gold very accessible, so the need to own, so the gold mining stocks don't have a monopoly on people who are concerned about monetary debasement. I think that's been a big factor.
Right. The spread between cash cost and the price of gold these days, it's you know, watching how far gold has run has got to be advantageous to the balance sheets of these gold
Huge,
companies.
yeah. I mean, the spread, I think the global cash cost number is something like $800, and take $1,600. That's an $800 spread. That's unprecedented.
And that's so at some point that would suggest that investments in the larger gold stocks are a pretty good idea.
I think these companies will be gushing cash flow, and they're going to bump their dividends and report record earnings, and I just think they're going to be too profitable to be missed out on by not just people who are interested in gold, but the generalist investor.
Right. Now, here's a question. Your fund has outperformed all the relevant indexes by a fairly wide margin, yet you're not really a trader. So how did you do it? Is it stock selection? Is it what's the secret sauce here?
The secret sauce?
Yeah.
Well, we have a big investment in research. We have a good team of 4 analysts plus me. We travel all over the world to look at gold mining assets in remote locations, whether it's the Arctic Circle or West Africa. I mean, we've been pretty much everywhere. Right. And that kind of gives us a pretty good lay of the land as far as the assets go. And I think the big thing is that we're willing to invest in companies at an earlier stage of their evolution than most, because we do have this kind of nitty-gritty feel for assets at their earlier stages. And so we'll get involved with an Cisco, for example, when it was a 50-cent stock.
Right.
It's now 14, and we finance them all along the way. And I think that makes a big difference.
Which is a good lead into the next question, which is the producers have, it's a business where you deplete your reserves on a daily basis if you're doing things right. How are they going to replace their reserves, and does that point to an opportunity? I mean, do you guys spend a lot of time looking at the companies that are most likely to get acquired?
Well, certainly, most years we'll have a couple of takeovers, and hopefully they're big positions in the portfolio, right. And that certainly gives us that certainly is a big factor in our performance. But the other thing is, we're very patient. We'll look at a company that may have made a misstep, but if we think the asset's any good, and if we think management is contrite, or maybe new management comes in, the gold isn't going to go anywhere. I mean, it's there. And so if they get things right, you're going to eventually see value created.
So, what to do now? Let's get practical. In the first instance, to take advantage of volatility, you have to have courage and you have to have cash. And cash gives you courage. You have to have liquidity. I was talking to a gentleman last night before dinner who said that he's afraid of holding dollars. I asked him to give me his. I have had periods of time in my life when I had lots of dollars, and I had periods of time in my life when I had no dollars. No mystery. I am happier now that I have lots of them. It is true that the purchasing power of US dollars or other fiat currencies are going to decline. Maybe 5% a year, maybe 6% a year, I don't know what the number is. Losing 5 or 6% a year in purchasing power beats the hell out of losing 30 or 40% in equities markets, okay? It's simple math. You have to have some liquidity, because if you don't have liquidity, you won't be able to take advantage of volatility. And having the cash in your portfolio may give you the courage to act. Maintain liquidity. It's okay with me if you maintain a lot of that liquidity in bullion or bullion-related products, as long as you understand that at least that part of your bullion isn't an investment, but is rather a substitute for other forms of liquidity. If you paid $1,800 an ounce for the gold and there was a more attractive opportunity elsewhere, and the gold was at $1,700, if you viewed it as liquidity and were willing to sell it at $1,700 to do something else with it, in other words, if you didn't have a psychological attachment to the gold, but rather were using the gold as a liquidity, that's a wonderful way to prepare yourself. But absolutely, positively, you must have liquidity. Do you remember 2008? Anybody here remember 2008? Do you remember what happened to people that didn't have liquidity? It was truly and profoundly ugly. And if you have the cash and if you have the courage to take advantage of crisis, the problem becomes other people's problem, not your problem. And while that isn't an optimal solution, it's the best that you can hope for. After liquidity, what are we doing? Well, I'm delighted to say that at Sprott, at least at my part of Sprott, we are increasingly attracted to precious metals equities. Why is that, people say? I mean, the precious metals equities have underperformed this year. That's why we're attracted to them. For the last 3 years, we have felt that precious metals equities have been rather expensive. We think it's no particular surprise that the gold price has outperformed the index of precious metals equities. We think this happened for 5 reasons, and I think this is important. You need to understand these 5 reasons. In the first instance, gold equities underperformed in the last 2 or 3 years because they performed so well 4 or 5 years ago. We think that gold equities anticipated the increase in gold and silver prices that we've seen in the last 2 or 3 years. The The second thing that we think happened in the context of the underperformance of gold equities has been the increasing attractiveness of the gold and silver-oriented ETFs. In other words, there's been disintermediation in investment markets between gold and silver equities and gold and silver represented by other forms of paper like the ETFs. The third thing, and this is much more problematic, has been extraordinarily poor corporate performance on the part of the view of the gold miners. You would have expected, at least I expected, that given the fact that their product price increased from $250 an ounce to $1,500 an ounce, a six-fold increase in product prices, that the free cash flow generated by the industry would have grown by leaps and bounds. But it didn't. In fact, free cash flow in the industry grew anemically. And the ratio of cash in to cash out, that is, exploration and development expenditures relative to free cash flow in the gold mining industry, actually declined for most of last decade. In other words, these guys, despite the fact that the product price increased sixfold, found a way to spend more money than they took out. In fact, the industry destroyed capital. No wonder the corporate performance was poor. The fourth thing is inflation, not the kind of inflation you think about. The kind of inflation that you think about is the issuance of phony paper by various governments. Well, let me tell you something. Wall Street and Bay Street and Howe Street, the people who print up gold mining share certificates, these guys do inflation like nobody else. Anything that the public sector can do, the private sector can do better. And these guys issued phony gold mining share certificates even faster than the Federal Reserve issued phony greenbacks. So although the prices of individual equities didn't go up, the market capitalization of the sector expanded dramatically. We went from probably 1,000 juniors worldwide to 4,000 juniors worldwide, and we had floats going from 20 million shares to 100 million shares. So the sector generated its very own private inflation. And the fifth thing, of course, is, at least with regards to the juniors, probably 80% of the issuers are absolutely valueless. They have no value whatsoever. I know you don't want to hear this, but it's important that you hear it to understand it. If you merged every junior gold explorer in the world together, let's say there's 3,000 of them, 4,000 of them, let's call it Vancouver Explore Co. It's not limited to Vancouver, they come from Perth and London and everywhere else. These 4,000 companies, if you look at the money that they spend on, exploration, stuff like that, fast women, slow horses, all the essentials in exploration, what you'll see is an industry that in a very good year loses $2 billion, and in a bad year loses $6 billion, $7 billion. So how do you value this business? Do you value it at 5 times losses? Or because gold is in favor, do you value it at 10 times losses? I mean, if these were technology businesses, you'd probably value them at 30 times losses. That's the question. So why, with this litany of complaints, would I possibly be buying gold and silver exploration stocks? Well, in the first instance, remember that we had price anticipation. That is, that the share price levels anticipated the growth in the bullion price. That's no longer the case. The delta between the increase in the gold price and the increase in the share prices has disappeared. With regards to the ETFs, as a consequence of the first, we think on a valuation basis, the equities offer better upside than the ETFs. With regards to poor corporate performance, finally, after 10 or 12 years of investments, the industry free cash flow is growing by leaps and bounds. We anticipate that the gold mining industry this year will generate as much free cash as they have generated in the last 10 years combined. This is the year where cash in by way of investment is generating cash out by way of operating margin. And this cash is extremely important. It allows these companies to grow organically without issuing new equity to shareholders. It gives them the courage and the ability to acquire junior companies to maintain their production profiles. And these acquisitions add both hope and liquidity to the system. This is extremely important. Script inflation. There are fewer and fewer issuances taking place as a consequence, first of all, of the legitimate companies having good free cash flow, and increasingly a confidence of the fact that people like you are much less likely to buy junk gold stocks than you were 6 or 7 years ago as a consequence of your own education. And this is very, very, very important. So we see for the first time in 3 or 4 years real value being offered in the gold and silver equities markets. We are particularly attracted ourselves to the smaller capitalization discoverers and developers who we think will be taken over by larger companies.